Hey friends, I want to share 3 stocks with all of you today. These are 3 value-oriented dividend stocks that I'm buying right now. I don't hear too many people discussing these stocks. The common element that aligns all 3 of these, even though they're in different industries, is the fact that they are value-oriented, they're defensive in nature, and they're the types of stocks that can weather any storm. The reason I am buying these right now is because of the election. Election 2024 has created a lot of uncertainty. We do not know what is ahead. But I think a lot of us in the United States and probably all around the world are a bit concerned right now about the future. So from an investing standpoint, I'm trying to buy stocks that are on sale, that are trading at value levels, and that are defensive in nature and can weather any storm. I want to buy the types of stocks that can thrive in any kind of environment and can almost act as a hedge, if you will, against political and economic uncertainty. And so I want to share these 3 stocks. You can see them on the screen now. I'm going to do a deep dive into each of the 3 today. You can see that the 3 stock picks that I want to discuss are Chevron, Pfizer, and the Hershey Company. I'm going to start with Chevron. It's all the way on the left-hand side of the screen. I've discussed this one recently. I'll link in the pinned comment below to my recent video about Chevron. It has traded back down a little bit in the last few days, so I'm excited about that. It's back down at $148. And what I like about Chevron is on a forward PE basis, it's a 14 this year and a 12.83 next year. What I like even more about Chevron is that the starting yield is a very healthy 4.39%. It's paying massive cash flow. This is something else that unites these 3 stocks. These are dividend stocks. These are stocks that are not only paying solid quality dividends right now, but also presumably will increase their dividends into the future. And so as you can see on the screen, Chevron right now is paying a solid 4.39% starting dividend yield. The payout ratio is only 61%, so they're going to continue to grow this dividend. And I have some more data on that in a minute. But you can see they already have been growing it the last 5 years by about 6.5% or 6.49% per year on average. Why am I interested in Chevron right now during election 2024? Well, oil is a valuable commodity no matter what type of economy we're in, no matter how well or how poorly the US dollar does. I look at oil is a hard asset and a valuable commodity, a hedge that belongs in my well-diversified portfolio. I'm going to go into this in a minute, but they have absolutely superb free cash flow growth. And so I believe that the dividend will actually probably continue to grow at a similar rate to the last 5 years. Also, I'm going to show in a minute, but they're the low-cost producer. In the oil super majors, Chevron is highly profitable, and they do not rely on the price of oil being too high at all. They can do well even in environments where the price of oil is lower. And so I actually want to share, I went to the investor relations website for Chevron. I looked at their recent investor deck, and I want to share a few slides that were really helpful to me because as I look forward, I look at my portfolio holistically. There's always a lot of uncertainty in our world right now. I like to invest for that. I like to plan ahead. I'm kind of underallocated, in my opinion, to the oil super majors. I'm kind of looking at Chevron here. I want to make this a larger position. I want to make this eventually maybe a top 10 position. I have a long way to go there, but I'm really excited. The more I dig into this company, I've owned it a long time, but I'm always learning more about it every day. And anyway, I went to the investor relations website and I pulled some slides for you all. So as you can see on the screen in front of you right now, the first slide that I want to share talks about how they are delivering higher returns. Okay, so on the left-hand side of the screen, you can see return on capital employed improvement. This is a measure of improvement of their deployment of capital. they are improving their return on capital employed quicker than the peers. And in fact, they're targeting greater than 12% return on capital employed by 2027. This is a company that continues to be effective at employing capital, and they are known in the industry as a lower cost, if not one of the lowest cost producers of oil, which is really great because they can be profitable even at lower price per barrel of oil. You can see on the right-hand side of the screen, free cash flow. They are expecting their free cash flow to go from 10 billion thereabout in 2022 to roughly 20 or even more by 2027. Free cash flow is growing very quickly. They're expecting greater than 10% free cash flow average annual growth. This is one of the most important metrics that I want to share in the video today because we have already discussed in the previous spreadsheet, they have a high starting dividend yield. We have already discussed their dividend growth rate. It's really high. But the question for the future is, can they keep that up? And I am saying, yes, I believe they can, because they are saying they're going to grow the free cash flow into the future by 10% per year on average. And that is an even quicker growth rate than the dividend growth rate. And so, of course, if that is to come to fruition, I believe they will be able to continue to grow that dividend. And so this is one of those kind of sweet scenarios that is playing out where it's rare to have a high starting yield with high dividend growth and being in an industry where I'm underrepresented in the portfolio. Sure, I can find this in the sin stock industry, but I own all those stocks. I'm over allocated to them. And so I'm excited about making Chevron a bigger position in the portfolio over time. And I'm excited about that because I have that high starting yield with the high dividend growth that is supported by free cash flow growth. But let's continue. As you can see on the screen in front of you right now, I have another slide from Chevron. I don't want to spend too much time on this, but you can see they're delivering unmatched value to shareholders. They're focused on costs. They're focused on capital efficiency. And what I'm really excited about here on the right-hand side of the screen is they're showing they have a higher dividend per share growth than the peers, and they're returning more cash to shareholders than the peers. And so this is a company that is aligning their actions with the shareholders like myself. So in the video last week, I'll link to it in the pinned comment below. By the way, thanks for your patience. I've been very busy at work. And so I know this video, I wanted it to come out sooner, but here I am. Anyway, in the video last week, which is in the pinned comment below, I shared a spreadsheet. And in that spreadsheet, it can help forecast true dividend yield on cost over time. And so I wanted to put Chevron to the test in that spreadsheet. So as you can see on the screen in front of you right now, this is the same spreadsheet from the video last week. And in this particular scenario today, I want to go through what happens to Chevron over time. We know that the dividend growth rate is 6.49%. They told us free cash flow is growing about 10% per year on average. And so I think they can keep up this dividend growth rate. If over time they can do that, we know the starting yield is 4.39%. But over the years, the true dividend yield on cost with reinvested dividends could get all the way up to 11.46% in about 10 years' time. This is why I do what I do. This is why I'm a dividend growth investor. This is why I seek value. This is why I think Chevron is such a good stock to share today, because they produce such a valuable commodity that will be valuable no matter what happens with the election, no matter what happens with the US dollar. Chevron is a company I'm just very excited about here because it can get me to that magic 10% yield on cost, true dividend yield on cost with reinvested dividends in about 10 years because of the power of the dividend snowball. Okay, I've spent a lot of time on Chevron, but put in the comments below, what do you think about Chevron? And if you're enjoying the video so far, I please do ask, please kindly click that like button. I want to move on. I've got a lot of ground to cover, so let's talk about Pfizer. As you can see on the screen right now in front of you, check it out. So Pfizer right now is trading at value levels. I love this. It's trading at $28. It's still under 30. It's down about 9.77% from the 52-week high. down quite a bit more from the all-time high. It is trading at a PE forward of 10.74, based on 2025 at a 9.92. It's another stock that has a very high starting yield of 5.9%. They're not growing the dividend as quickly, and I don't expect them to. The 5-year dividend CAGR is about 3.13%. The reason I don't expect this dividend to grow very quickly is because they acquired CGen for $43 billion. This was late last year in 2023. They're going to have to deleverage their balance sheet. They're going to have to pay off debt. They're not going to grow the dividend very quickly here, but I think into the future, they have a possibility of doing that over time as more debt is repaid. But why I'm really excited about Pfizer right now, I would say mainly is because it has a low PE ratio. It has a high dividend yield, cash flow, massive cash flow right now. Largely, this business is not tied to the economy. People are not going to sacrifice their health in times of economic uncertainty, in times of political uncertainty. Our population is aging. There are a lot of ailments out there in our world, unfortunately, but Pfizer is doing their best to troubleshoot. Especially, I'm excited about their oncology division. Revenues are up 31% year over year. I think they made a smart acquisition with CGen, although it was expensive. They just increased their guidance by about 11 or 12%. And there is a activist investor now getting involved called Starboard. And these activist investors, in the olden days, I did not like them. Now I do, because they put a lot of pressure on management. And I like to see a little pressure on management here at Pfizer to do better than they have, to grow the business quicker, to be more efficient with their business. And I think that's exactly what this activist investor is going to put a little pressure on them. And so I am so excited about that. But I think Pfizer right now, before the election, it's a great stock for me at least, because I could stand to have more exposure to healthcare. I don't think healthcare is going to suffer no matter who is elected, no matter how much uncertainty there is. And I see a lot of promise moving forward at Pfizer with their oncology division in particular. But as you can see on the screen in front of you right now, I have a slide from Pfizer. Again, I went to the investor relations website for this company, wanted to dig around and see what I could find. And I have some interesting information for you. What I wanted to share was basically this slide that they're raising the 2024 revenue range and adjusted diluted EPS range. This is where I got that number that they're raising it by 11% or 12% when you look at the previous numbers, when I was looking at adjusted diluted EPS versus the prior guidance range. And so this is a company that I think it is in transition. Here's one of the unifying factors of these companies as well. I like to buy stocks when there's a little bit of uncertainty. I know business growth is not linear. I know there will be plateaus, there will be setbacks before the next big leg up in terms of growth. And I would say one thing that's common between all of these companies, but I would say especially, I don't really, Chevron honestly is doing great, but I would say with Pfizer and Hershey in particular, is they're kind of hitting a plateau, both of them. They had slowed down. And this can create value. This can create uncertainty. When there is uncertainty, I like to buy high-quality businesses that I believe will start growing again and will support future dividend growth. And so whereas Pfizer has a very strong starting dividend, and it's probably not going to grow very quickly in the next few years, eventually I see it growing, and I see the opportunity for a 10% yield on cost, true dividend yield on cost. And a lot of that will come from, on that equation, from dividend reinvestment, even though I'm not reinvesting Pfizer now. I'm just talking hypothetically. I'm using Pfizer dividends to pay bills, honestly, as am I with Chevron. But I'm looking for a true yield on cost opportunity, looking about 10 years out of 10%. That's fine with me. I could see Pfizer possibly doing that, but it will be more weighted on the latter years. But I do think the dividend reinvestment will help it out even in the early years for those that are reinvesting dividends. Okay, so the third stock that I want to discuss today is Hershey. I actually don't own this, but my kids do. I buy it for my kids for gifts, for Christmas holiday, for birthdays. This is one of the stocks I love buying for them. They've certainly hit a plateau with the price of cocoa being a little high, with the just consumer being a little more skeptical, a little slower to make purchases these days because the economy is kind of challenging, because right now inflation has been high. But this is one of those iconic companies that rarely trades at a PE ratio where it is right now. And I think it is hitting a plateau. I don't think they're going to solve anything super quickly, but honestly, they're paying the investor to wait. Check it out on the screen right now. So with Hershey, this is a longer term play, but let me just start with the subjective stuff. Hershey, when I look at it, in the last few market crashes, it has had a pretty reasonably low drawdown. And the reason is simple pleasures in life are great during times of uncertainty. The market knows, hey, this is a market crash. This is a bad economy, bad recession. People are going to be eating the very products that Hershey produces. And so I love those moderate downside. And I think this is perfect because we don't know what's happening after this election. We don't know if the market is going to crash. The market seems kind of a bit frothy right now in general across the board, although the stocks I'm covering today, I believe they're all trading at values more or less. But I think there could be some downside depending on how the election goes. But I think Hershey is one of those companies that is a flight to quality whenever there's a market crash. Yes, there is low growth right now, but this could be the one rare buying opportunity that honestly we see in Hershey because it's rarely on sale. Anyway, I highlighted, it doesn't seem that exciting, but I rarely see Hershey trading at a PE below 20, so that's why I highlight it. Even more importantly, I rarely see a dividend yield of 3% on this stock. 3% is a great starting yield for this company, which historically has had lower starting yields. And so for my kids, especially because they have a longer term time frame, I love buying this. The dividend growth rate on average is 12% per year. I don't expect that to hold up in the next few years. I think they will have to start growing the company more quickly to sustain that, but the payout ratio is reasonable, under 60%. But still, I think really at a high level, the way I'm looking at Hershey here is it's an iconic company. It's trading at a reasonable fair PE, I would say value for Hershey, but in the universe of investing, it's kind of a fair price. Investors being paid to wait, and I think it could weather election uncertainty very well. As you can see on the screen in front of you right now, here's why Hershey stock is not doing that well. It's because of the business. They're showing that the full year outlook for 2024 is 2 to 3% sales growth, and no adjusted EPS growth. Adjusted EPS is not going to grow. They are facing some challenges right now, but I think because of the challenges, it's on sale for investors like my kids who have some time to wait. So everyone, thank you for watching today. Please put in the comments below what you think about the election and the uncertainty ahead, and whether you think these 3 stock selections today are reasonable stocks, value dividend-oriented stocks that could weather any storms that come our way. I know I'm excited to be buying all 3 of these right now and over the course of the next few weeks. Thank you for watching. If you enjoyed the video, please don't forget to subscribe to my YouTube channel. Before we go, in terms of a full disclosure, I own the stocks mentioned today. I'm long Chevron, ticker CVX. I'm long Pfizer, ticker PFE. My kids are long Hershey, ticker HSY. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Thank you for watching. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.